Qualcomm stock is down 25% year to date. For the architect of the 5G revolution, that is a massive haircut. Is this a rare discount on a chip giant, or is the market finally pricing in the fact that Qualcomm's best days are behind it? Qualcomm isn't just a chip maker, it's the invisible architect of global connectivity. Every single 3G, 4G and 5G smartphone on the planet likely uses their technology. I'm Edward Galstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Let's break Qualcomm down through our 5 key factors to understand whether it's undervalued, fairly valued or overvalued. We'll analyze the economic moat, return on capital, growth, financial strength and valuation. Now let's start with the moat. Qualcomm holds a narrow economic moat driven by intangible assets, specifically a massive treasure trove of patents. They operate like a global toll booth. Virtually every handset maker pays them a royalty fee just to access the essential wireless patents needed to function. Beyond licensing, their Snapdragon processors are considered best of breed, found in almost all high-end Android devices. However, the moat isn't wide because of growing threats. Apple is aggressively trying to build its own modems to cut Qualcomm out, and Samsung has similar in-house ambitions. They are the kings today, but the castle is under siege. Now before we go into the numbers, this is where the story needs to be backed up by data. To break down Qualcomm's returns, growth, financial strength and valuation, I'm using Fiscal, the research platform I personally use. If you want to follow along with the same charts and peer comparisons, there's a link below that includes a 15% discount at no extra cost to you. Returns on capital tell us how efficiently management turns investor capital into profits. And Qualcomm's numbers are respectable, but trending in the wrong direction. Return on invested capital is 14.9% and return on equity is 23.3%. The concern here is that both return on invested capital and return on equity have been declining in recent years. Now if we compare return on invested capital to peers, Broadcom sits at 17.1%, MediaTek at 15.5% and AMD at 6.6%. Now on to return on equity, Broadcom sits at 31%, MediaTek at 25.9% and AMD at 7.1%. Qualcomm is lagging behind Broadcom and MediaTek in return on invested capital and return on equity. Now on to growth. And this is where the story gets into a warning zone for me. Over the last decade, revenue grew at a compounded annual growth rate of 5.8%, net income grew at a CAGR of 0.5%, and earnings per share grew at a CAGR of 4.5%. Notice that earnings per share is growing much faster than net income. This is because of a massive buyback program. In 2018 alone, they launched nearly $30 billion in stock repurchases after a failed bid for NXP Semiconductors. But the major concern here is the looming Apple loss. Qualcomm currently anticipates being cut out of 80% of iPhone modems in fiscal 2027 as Apple transitions to its own in-house chips. While Qualcomm is aggressively pivoting into automotive, targeting a 33% growth rate in that segment through 2030, this new revenue is still relatively small and hasn't yet offset the stagnation in the core handset business. Now if you compare earnings per share growth to peers, Broadcom sits at 25.7%, MediaTek at 15.4% and AMD had negative earnings in 2015, so we can't compute the CAGR. When your peers are growing earnings at double digits and your actual net income growth is flat, 0.5%, it's a sign that financial engineering is masking a stagnant core business. Despite the growth concerns, the balance sheet is rock solid. Total cash and cash equivalents sit at $10.2 billion and total debt at $14.8 billion. Free cash flow sits at $12.8 billion and this gives them a free cash flow to debt ratio of 86.5%. Basically, Qualcomm could pay off almost its entire debt load with just slightly over 1 year of free cash flow. This is high-quality financial health. Even the greatest business can be a poor investment if you pay too much. Valuation is the final filter for our margin of safety. Now let's talk price. On the surface, Qualcomm looks cheap with a forward price to earnings of 12.4. Historically, they've traded between 9.3 and 23.2. And compared to Broadcom at 23.2 or AMD at 30.3, it looks like a bargain. However, the market is pricing in the high probability that Qualcomm will lose 100% of its Apple modem content in the long run. When we dig into the PEG ratio, the red flags appear. Based on a long-term earnings per share growth estimate of 4.5%, we get to a forward PEG ratio of roughly 2.8. Now, based on historical growth, which was 4.5%, we get to a trailing PEG ratio of roughly 6. A PEG ratio this high suggests that even at a low price to earnings, you are paying a massive premium for very little growth. For a company with stagnant net income, these multiples are hard to justify. So let's bring it all together through our 5 key factors. Qualcomm's moat is narrow and under pressure, as Apple wants to build chips in-house. Return on invested capital is 14.9%, but trending downwards. Qualcomm has stagnant net income growth of 0.5% over the last decade. Financial strength is excellent. Total free cash flow can clear all debt in just over 1 year. While the price to earnings ratio is low, valuation is steep with a forward PEG ratio of 2.8. In my view, Qualcomm is a value trap. Investors are paying for financial engineering rather than actual business expansion. Until they can prove they can grow the bottom line without just buying back shares, I believe there's still more room to fall.